Hello and welcome back. My name is Joe Cass. I'm a senior director here at S&P Global Ratings, and I'm the host and the creator of the Ep15 podcast. So on this episode, we have Andrew Howard, Global Head of Sustainable Investment at Schroders, and Christa Clapp, Managing Director in Sustainable Finance at S&P Global Ratings. As always, very quick reminder that the views of the external guests are their views alone and they do not represent the views of S&P Global Ratings. Andrew, let's start with you. Would you be able to share with us your career path thus far and how you ended up managing sustainable investments at Schroders?
Sure. Well, I can certainly try and try and piece this together. So I started about 25 years ago. I started my career in investments out of university as a mining analyst about the time of the Asian crisis. It's still not entirely clear to me why I was given the job of being a mining analyst, but such was the way of the world back then. One of the things that struck me was that every time I would go and visit mining companies, the management teams would insist on talking to me about health and safety, what they were doing with local communities for 15, 20 minutes at the beginning of every presentation. And as an analyst, I'm sat there thinking, I don't know what to do with this. I've got my financial model. This doesn't seem like a cost that I should be treating as a cost line. I don't know how this connects with what I'm doing as an analyst trying to value the business. And it struck me that there was a bit of a disconnect between the outputs, the financial numbers that we were looking at as financial analysts, and the way that management teams were running those companies. And in many ways, the following few years were really a journey in trying to figure out how to bridge that gap. I did an MBA for a while. I worked as a management consultant for a while. Frankly, neither of them entirely solved that problem. And then I went to work at Goldman, where I stayed for about 6 or 7 years, when Goldman was just starting a research team focused very much on long-term investing and really trying to understand the long-term health of companies, which started to connect those two things really in a way that, subsequently I joined Schroders in 2016. And that basic principle of how do we connect what's happening in the real world, the stuff you read about on the front pages of newspapers, to an understanding of how we're assessing investments, the implications for businesses, and ultimately the implications for the value of those investments and the value of those portfolios in a way that really tries to connect what we're seeing in the real world with the way that we analyze investments and we build portfolios.
Great. Thanks, Andy. And Christa, similar kind of question for you. Can you give us an introduction to yourself and also your career thus far?
Yes, so I'm a co-founder of Shades of Green, which was acquired by S&P Global about a year ago. But my career journey has been more focused in climate policy research and economic analysis. And the thing that motivates me the most is to understand how climate research can connect to financial decision makers. So I've been trying to work in the nexus of climate research and finance for a number of years. And I used to lead the climate finance research team at Cicero, which is an international climate research institute based in Oslo. And that's where we developed the Shades of Green methodology that we're using today to assess green bonds.
Great. Thanks, Christa. Andy, can you provide an overview of how Schroders approaches sustainable finance and how you look to integrate ESG factors into your investment strategies?
Mm-hmm. Well, I mean, first and foremost, sustainable finance is a component of finance. Ultimately, for us, this is an investment problem. And to me, it's probably one of the most important and one of the most, the biggest opportunities within our industry in terms of how we think about connecting what will be extremely disruptive changes, climate change, inequality, social unrest, nature loss. If you sort of think about the magnitude of impact that those trends can have on industries, on economies, on the value of individual companies, the potential disruption is going to be significant. We're already starting to see that playing out in some areas. And there aren't that many areas of our industry where you can see something that can be as significant and disruptive as social and environmental change are already proving to be, where the knowledge and the understanding of how to tackle those questions there's no textbook, there's no definitive approach as to how you do this, and where the opportunities, therefore, to come up with better answers and better ways of solving those problems is therefore particularly, I think, important and particularly compelling. So for us, the starting point really is to, in the context of an individual investment strategy, in the context of different asset classes, understanding what are the ESG factors that matter to what will drive the future performance and understand the valuations and the business models of companies in different sectors and assets in different kinds of in different areas of the market. and then to ensure that we are creating the tools, the analysis to understand those trends and their implications as effectively as we can. I hesitate to call this a data-driven process. Data in the ESG space is not like data in some other areas. There is a lot more data available than there was 10, 15 years ago, but still judgment is a really important part of this. This is not an exercise in simply plugging some numbers into a computer and seeing what comes out. And embedding that sort of knowledge and those sorts of questions into the way that we make investment decisions across different parts of the business has been really critical, ensuring that that's then reflected in how we build portfolios, how we select individual investments, and then equally importantly, how we go about monitoring those investments and engaging with investee companies, engaging with the assets that we've invested in to help them to transition and adapt over time is a really important part of that exercise. So it's very much about thinking about sustainability or ESG factors throughout the life cycle of the investment process, rather than simply thinking about it as a compliance exercise. It's not a screen, it's not a filter, it's not a rule that you apply. It's about trying to recognize and incorporate social and environmental change into each step of the investment process.
Great, thanks, Andy. Christa, can you tell us kind of the story, I guess, of how you initially developed Shades of Green, how the methodology works, and how it now integrates into S&P Global Rating sustainability practice?
Yeah, so something that Andy just said really resonates also with the story of how we developed the Shades of Green methodology is that it's not a data-driven process. The data isn't good enough for us to be able to make it a data-driven process, maybe in the future. But right now it involves a lot of trade-offs across, we're more focused on climate, but across environmental factors and ESG factors and scenario planning and risk management. And so all of those things can be, I think, informed a lot by qualitative and opinion-based analysis, which is what we're doing with the Shades of Green methodology. But the start of it was, as I mentioned, back in this research institute, Climate Research Institute, nonprofit group in Oslo. And we set up an advisory board of investors to understand what they wanted climate research to help inform. And it was a real learning exercise for everyone because this was back in about 2014. We had a room full of, we just brought climate scientists and different types of investors together, put them in a room and thought, let's see what happens. And the climate scientists said, well, what do you want to know from us? And the investor said, I don't know. What can you tell us? That's really, the starting point was a bit awkward. And of course, it's learning. And over time, it became much more refined about actually what can we say from the climate science. And there are a number of different modeling platforms. There are a number of different scenarios. It can be quite confusing. We don't have a crystal ball. There's a lot of different metrics we're looking across and a lot of trade-offs. But we can say something. We can actually look across all the scenarios used for the Intergovernmental Panel of Climate Change, the IPCC. That's the UN climate assessment report that comes out every 5 years or so. And we can say that across all those scenarios, to be aligned with the Paris Agreement targets, you need transformation in every single economic sector where you hit about zero greenhouse gas emissions about mid-century. That's a very rough rule of thumb, but we use that as a basis to talk about the Shades of Green. And then we thought about how can we compare across different investments about how well positioned they are for the zero emission future, and the future where we're also facing more physical impacts of climate change, where we're also facing more economic impacts from flooding and heat stress and hurricanes and all these things that we read about in the news today. And what we knew is that we didn't have enough precision or enough data to score on a 0 to 100 point scale, that would be false precision. What we could do is say, let's put them into 3 buckets. And we started with a simple 3. So we have light, medium, and dark green. And we can communicate that about a particular investment. And then an investor can make their own decisions if it factors into their own sustainability strategy, or if it may complement or supplement their own internal analysis. And then they can decide what level of green that they are comfortable with. And so for us, the dark green end of the scale, that's our top shading. That means it's essentially zero emissions by mid-century. It's essentially Paris Agreement aligned. It's things like renewable energy is a common thing. But of course, we're also paying attention to environmental impacts throughout the supply chain. So it is a complete value chain perspective. But a lot of renewable energy falls into that dark green space. At the other end of the scale is light green. The light green is quite interesting because it can represent very significant emission reductions, but at the same time has not transformed fully away from fossil fuel use. So these are important starting first stepping stones towards climate transition, but they may have very different starting points depending on the region you're looking at or even the sector technology you're looking at. So it gives us a little bit of flexibility. So you can probably guess by the way I'm describing the methodology, it is not data-driven. It's not taxonomy-based. It's actually principles-based. So we are able to take into account the context of a particular investment, a particular company, and situate it into our three shades. And Jill, you also asked about how we're using it on S&P today. So it is now an integrated S&P ratings methodology. And we spent the first 6 months after our acquisition focusing on that. So a couple months ago, we came out with that, and we use it to assess both green and sustainable bonds. The green projects within those bonds are assessed according to the Shades of Green methodology. And we've integrated our team coming originally from the Research Institute and now into S&P ratings as well.
Excellent. Thanks, Christa. Andrew, shareholder engagement and proxy voting, they're very powerful tools in the world of sustainable finance. Would you be able to provide a couple of examples or instances where Schroders has engaged with companies to influence their ESG practices?
Absolutely, and quite topical, particularly in the context of this climate discussion. I mean, just to put things a little bit in context, so Schroders, we have an intention. We are transitioning our business, including the portfolios that we manage, towards a lower carbon world, and ultimately we are towards a net zero world by around mid-century. We have had our targets validated by the SBTi. We're a founding member of the Net Zero Asset Manager Initiative. I say all of that because that's the easy bit. In many ways, establishing targets is the straightforward part. The tricky bit is how do you get there? And our focus is very firmly on transition. And I tend to say there's only really two things you can do as a fund manager. You can pick the right assets or companies to put into a portfolio in the first place, or you can look to add value to those assets through the way in which you engage with them, through the way in which you own them, and through the influence that you can apply. And I think that latter component is becoming increasingly important, where more and more of the world's companies, more and more of the world's industries will need to go through a transition to get us on the journey towards a decarbonizing world. And so for us, engagement, transition, the active ownership, stewardship part of investment is a really critical part of how we're delivering that. So to give you an indication, for the last few years, we've engaged around about 700-ish companies per year on climate-related topics. That's very much a firm-wide effort. So our fund managers, our analysts across different investment teams are part of that exercise. What we have found is that the companies that we have engaged have been about twice as likely to establish emission reduction targets as companies we haven't engaged. We found that they've cut their emissions more quickly, and equally importantly, they've delivered better performance than companies that we didn't engage. So you put all of it together, and I think the ability to engage and be part of that transition, which can unlock real value in terms of not just carbon emissions, but also shareholder value and shareholder returns, is going to be a really important part of how we see this journey, rather than just simply thinking about it as let's sell high carbon companies, let's buy more low carbon companies. Yes, your portfolio decarbonizes, but it's a restrictive approach to transitioning rather than a dynamic one. So I think that transition point is a really critical one, and in particular in the context of the conversation we're having around data, that there is a real challenge with, I think, in this industry, people getting a bit stuck waiting for perfect data. It's going to take an awfully long time. The number of times that I'm handed charts that show me temperature alignment scores to 3 decimal points, and I have to scrub all the decimals out because it's a false level of precision, given how what we know the underlying data looks like. But even without that, we know that there are some relatively straightforward things that companies are going to need to do. They're going to need to establish an intention to change their business. They're going to need to deliver progress on that. They're going to need to set themselves up to deliver that transition. And almost without the data, you can still really start to make a real difference, I think, in terms of how companies prepare for what will be a transition that is quite unlike anything we can look back at and say, how did this play out before? There is no sort of example from the last time. It's not like when rates went up and we can look at what happened last time rates went up and we can do a big quant analysis of it. It doesn't work like that. It has to rely on logic, and it has to rely on common sense and knowledge. And just at the end, company and industry understanding.
Thanks, Andy. Christa, can you talk a bit about the climate financing gap? What is it and why should investors be paying attention to it?
Yes, of course. So one of the hats that I wore at the Cicero Climate Research Institute was as a lead author for the IPCC Climate Assessment Report. And this is an assessment report that takes multiple years with multiple researchers around the world assessing the latest climate science. And so the headlines are rather depressing from this report. And the headline on the climate finance gap was that we are 3 to 6 times below that, and it's the magnitude of trillions, depending on how you measure, from where we need to be investing in clean energy and zero emission technologies and resources in order to meet our climate agreement goals under the Paris Agreement. And that means when you take the balance of financing towards fossil fuel subsidies, for example, and you think about all the other green investments we're doing, like in the green bond market, it's not adding up in the right direction for the climate. But beyond that, it's actually, I think, more interesting even to dig into the details because it's kind of an obvious message. We aren't spending enough money in the right direction. It's actually hitting both developing countries and adaptation projects the hardest. So 90% of what we can measure is actually going towards mitigation. That's great, towards reducing emissions. The problem is that we've already locked greenhouse gas emissions into the atmosphere, and it reacts according to what emissions we already emitted in the last few years and are already in the atmosphere. And based on what we do today and tomorrow, 10 years or so from now, the atmosphere can adjust. But so we are already locked into physical impacts of heat stress and flooding and hurricanes that are both planned to increase in magnitude and in frequency across many of the climate scenarios. So this means that, especially in developing countries, you have local populations that are extremely vulnerable to increased physical impacts in the next decade and aren't receiving the financial support. Now, part of that is the type of capital markets we have and maybe lack of transparency and lack of maturity in some of the developing countries and emerging markets. But it also has to do with the financial paybacks and that type of structure. It's something that's a little bit less likely to fit well in a green bond as an infrastructure project that's going towards supporting renewable energy, for example. So there's a couple complications there. And I think the result means that we have plenty of capital in the world. Is how do we redirect it towards both closing the transition financing and the adaptation financing gap? And part of that is not just the responsibility of the financial sector. It is also that nexus with policy interaction and risk sharing mechanisms. So it means a lot more cooperative work, and the financial sector has a big role to play there.
Thanks, Christa. Andrew, how do you see the role of sustainable finance evolving in the coming years, and what new strategies or approaches is Schroders considering to really kind of stay at the forefront in this sector?
Mm-hmm. Well, I think some of Christa's points there really just underline the importance of finance and the investment industry. You've got, what is the point of finance? At the end of the day, this is ultimately about connecting surplus capital or capital available for investment with areas of need in the real world that can generate an economic return on that investment. And there aren't many areas of greater need in the real world than tackling climate change and mitigating its future impacts, along with nature loss, along with the whole spectrum of sustainability, social, environmental challenges that we're all increasingly familiar with. And the finance industry, I think, ultimately is going to have to change to reflect the way in which we connect capital to those areas of the world that need that investment. I think there has been a tendency, which is fading a little bit, but there has been a tendency to think about climate investment or sustainable investment as being something that one chooses to get exposure to. I think certainly our starting point is that every investment is exposed to climate change, whether it's the physical impacts of climate change or whether it's the policy and social response to the threat of climate change. We're all exposed. The only question really is whether you're taking that exposure consciously or whether that you're sort of hoping for the best. And I think our approach has been very much to try and be proactive about that and to try and understand where those risks might emerge before they happen rather than wait for them to happen. And I think, look, in that context, as I think about how are we evolving, how we think about these topics, in particular around climate change, a lot of the discussion has been around climate change or climate transition as a constraint, about almost sort of separate from the investment process. How do we go about reducing portfolio emissions? How do we set long-term targets? and then essentially using that as a constraint that's applied to portfolios. I think that's the wrong way of looking at it. Ultimately, thinking about climate transition as a way of managing risk, a way of finding opportunities, making climate analysis part of the investment inputs rather than simply a constraint on portfolio outputs, recognizing, as we've seen over the last few years, valuations go up and down. If you look at the valuations on clean energy companies relative to traditional energy companies, we've been on a real roller coaster ride over the last few years. Valuations matter, fundamentals matter, and understanding how we can use climate risk as part of that journey rather than simply a constraint or a sort of limit that we have to operate within for that journey as a whole. So I think that real shift that we've really tried to make, and I won't pretend we have all of the answers, but I hope we're asking the right sorts of questions in terms of how we use climate analysis as an input into the investment process, with the result that portfolios transition, portfolios decarbonize, but as a consequence of that investment process, rather than simply thinking about this as a constraint that we have to operate within. And very briefly, the other area I think that's going to become increasingly important for our whole industry that we're quite focused on is how we really ensure that investments are connecting to real world change. There's a growing number of our clients certainly are looking for ways to understand how their investments connect to change in the real world. A few years ago, we invested in a company called Blue Orchard, which is a leading impact investment firm. We've really tried to focus on how do we take that DNA, that experience that Blue Orchard had built up, apply that across the Schroder Group to build impact investment products and impact investment frameworks and funds across Schroders and different asset classes, again, with the goal of really trying to connect finance to real world change in the same way that we're connecting real world change to investment decisions in finance.
Great. Thanks, Andy. And Andy, what view or opinion from the world of sustainability do you believe to be true that few others would agree with you on?
It's just tricky. There's so many people. When I started in this area, there were hardly anyone. It's quite easy. I probably knew most of the people in sustainable investment, and it's growing massively. So finding something that's still controversial is kind of tricky. But if I look at the numbers, I think the growth of passive type investment strategies in this area would imply, at least, that an awful lot of people think that we can approach sustainable investments just as a somewhat formulaic exercise, an exercise in applying ratings, applying rules, and managing portfolios that way. I think that's an area where certainly I would feel differently. I think in many ways, sustainability is about a set of disruptive challenges that are going to impact different companies, different industries, different economies in ways that we can't perfectly model, we can't analyze in a purely quantitative lens. The things that have made companies successful in the past won't be the things that make them successful in the future. And there's really no shortcuts but to applying logic, brain power, knowledge, and understanding to how do we think this will play out? What's our best assessment of how that change is likely to play out, where the opportunities will come from, where the risks will come from, and forming a logic-based view of the future. I sort of think about it a little bit like driving along the road. If the road is straight, driving through the rear view mirror is perfectly fine. When the road starts to bend, driving through the rear view mirror, you crash quite quickly. And I think in some ways, whether it's, I framed it in terms of passive or not passive, but the reality is that understanding that the future will look different to the past and looking at things without the safety net of quant data and back tests and 30 years of history is going to be the only real way to safely navigate the changes that we can already see starting to come through, and as Christa's outlined, are already very much playing out in the climate area, as well as a range of other areas.
Thanks, Andy. So, Christa, green or sustainable bonds now equate to 15% of all global bond issuance. How are investors comparing the relative greenness of bonds, and what challenges do they face when investing?
Well, every investor is different. They have different mandates and different ways that they assess their own risk and different ways they look at sustainability. So hopefully what we're doing as a second opinion provider in the green and sustainable bond market is providing a way to compare. But it's not easy because every second party opinion provider has their own methodology. On top of that, we also have a lot of regional differences. Andy, I think you talked about, a road that's not quite straight. That's definitely how I would characterize the green and sustainable bond market. If I look back from the beginning when underneath the Cicero Research Institute, we provided the first second party opinion on the first green labeled bond in 2008 to where we are today. And one of the biggest changes is what's happening in different regions around the world. We have both the EU regulatory space that's advanced rather remarkably in the past few years. And now we also have regional taxonomies for what counts as green popping up basically everywhere. We have them, everywhere from, Singapore, Australia, Canada, the categorization in China, and many others. And I think that is maybe one of the biggest challenges today. Of course, I can't speak from the investor angle, but it's a challenge for us too. We have our own methodology that we can layer and supplement when we look at different taxonomies, and we find that useful because it is hard to map some of these taxonomies together. Some of them are a list of just green projects, which is the approach the EU has taken. Others are more of a traffic light approach, where they're looking at some of the earlier stage transition, where we might be able to map to a light green or a little bit off the green scale in our shading spectrum. So we can use that as a common language to talk across different regional taxonomies. So that's what we're aiming to do. And I think we can expect this to be a bit of a messy space for a while. I don't see a future where we have one, global agreed taxonomy. I think every region needs to think about their own resource base, their own technology development, and what they're comfortable with. But as an independent opinion provider, we can help try to provide some communication across those taxonomies.
Great. Thanks, Christa. And Andy, as an investor in green bonds, what do you like about them? What don't you like about them? And what resources do you call upon to kind of refine your analysis before investing?
Well, I think I thought for a minute we'd managed to get through a whole discussion without talking about regulation, but foiled. But fully agree. I mean, I think your point, Christa, that there's more, and there's only ever more taxonomies being created. This whole area is becoming more and more challenging to distill nicely down into a little box. But I think to your point, Joe, they have become an unavoidably large part of the market. And it's not just for green bond funds or specific funds. Actually, they're a large part of overall issuance. One of the benefits of that is that as the markets become bigger and more liquid, one of the historical challenges, which is around the greenium, or the idea that green bonds were priced at a less attractive rate, generally for the investor, more attractive for the issuer, than other conventional bonds from similar issuers with similar credit profiles, that greenium has to a large degree dissipated in most parts of the market. And it's slightly different in sovereign space, where it's still a relatively small part of sovereign issuance, but it has become a much more liquid, much more conventionally and evenly priced area. I think very much to Christa's point, it provides a much more focused way of investing. And I think for a lot of our funds and for a lot of our investors, that's a very helpful feature, where we're creating funds with exposure to specific kinds of investments or specific kinds of projects. What I will say as well, perhaps sounding tangentially, it's also really helpful in understanding the issuer and the company that we're investing in. So oftentimes the information that one gets through a green bond actually gives us a lot of information about what the company is doing in aggregate, what its strategy is, how it's planning to deploy capital, how it's planning to invest, and what sort of targets they're setting across the firm. On the other hand, it's challenging when we mentioned the sort of confusion issue. There is the data, notwithstanding the number of different taxonomies and everything else, the ability to populate those taxonomies with hard data is still often quite tricky. The ability to compare between different sets of information provided by different issuers is still often quite tricky. And there's a long way to go before we really get that kind of as much transparency or comparability as we might like. On the other hand, say we have analysts, we have credit analysts covering different sectors, different companies, being able to combine their knowledge of the industry, the context of the industry, and looking at the specifics of a particular issuer on a particular issuance is how we try to tackle that, by really putting together, say, the company-specific knowledge with that perspective on the green bond itself.
Fantastic. Andy, the very last question, and it goes to you. So I'm lucky enough to interview leaders and influential individuals like both of you two from the world of finance, usually on this podcast. So thinking about everyone you've met, anyone you've worked with, or just people you've kind of seen from afar, who would you think could be an interesting potential guest I could ask to join a future episode of this show?
Well, I'm probably about to annoy all of my previous colleagues in one fell swoop. But I actually think that in many ways, some of the most important figures for our industry won't be of our industry. Now, obviously, I'm looking at this to a large degree through a sustainability lens. But if I look at the last few years, and I'll try and be non-partisan about this, but whether I think about people like Al Gore and what they did in terms of raising awareness around, or what he did in terms of raising awareness around climate change, or if I look at people like Vivek Ramaswamy and what we're seeing currently in the US in terms of that debate, I actually suspect personally that a lot of the influences that will impact our industry most come from outside of our industry, whether that be social activists and social activist groups in this part of the world, organizations like Just Stop Oil, whether that be pro-activists or the other end of the spectrum. And there are a growing number of organizations that are, say, anti-ESG or anti-woke. But I think that discord, that discussion that's happening beyond the edges of the finance industry is going to be a more important influence on our industry in many ways than many of the voices that are currently in our industry. And I think we often tend to look a little bit too narrowly when we look at this. So not a very precise answer. I probably annoyed lots and lots of people that I work with and have worked with, but that's my take.
Perfect. No, that's great. Thank you, Andy. Appreciate it. So thank you both, really. Thank you, Andrew. Thank you, Christa, for your time today. Fascinating. So for everyone watching, everyone listening, see you next time on Fixed Income in 15.